Gold's been on quite a run this year, breached $4,000 for the first time in its history. It took a bit of a dramatic pullback in recent sessions. Got a lot of people asking questions about gold. Can the rally continue? Are the fundamentals still there? Joining us now to discuss is Daniel Galley, Senior Commodity Strategist with TD Securities. Daniel, great to have you back on the program.
Yeah, of course. Thanks for having me.
You got the question, if not of the day, of the week, of the month, perhaps even the year. What is going on with gold and what can we expect going forward?
Yeah, I mean, that's a fantastic question. But the way that I would look at it is that thus far, over the course of the entire bull market in gold, it's really not been a question of demand. It's been a question of trust, right? And for this year in particular, trust in the US dollar, trust in US institutions has really been the factor that's been changing. How else can we explain this idea that stock markets are doing quite well and credit markets are at their tights and we're in a nascent bond market and commodity prices are rising and gold prices are ripping, right? The common denominator is really the answer there, which is the US dollar. So this is another way of saying the debasement trade has really been the primary driver. And when I think about the next few months, I actually think that we could be nearing an inflection point for the debasement trade, which means that it can either be reinforced or actually it can be challenged. What I'm specifically thinking about here is a few of the Supreme Court decisions that are on the docket between now and likely January of the new year.
We've had guests on the show, and I think maybe even some of your colleagues like Bart Melek talking about the fact that you take a look at gold at these levels. Can it go higher from here? Of course it can. Can it go lower? Of course it can. Is this, when you talk about all these different catalysts coming, is it very hard to sort of peg gold at saying we're going to get another sizable up leg or just sort of stay where we are?
Yeah, I mean, the way I think about it is I think about it in terms of the flows. Who's buying and who's selling? And when you think about who has bought gold in the last $700-800 rally, it's really been quite different than who has been buying gold over the course of the bull market. We see signs of extreme FOMO from several different cohorts, including discretionary traders or macro funds, including systematic trend followers who recently have been actually selling. Concerning to me is this idea that retail participants probably have their highest exposure in gold since at least 2011, which was another meaningful year for a pullback. So, from a positioning perspective, it's all lining up towards extremes, but some of the more structural drivers, such as central bank demand, remain strong, but has been weakening year to date, right? The total number might still be elevated, but it's less elevated than the prior year, which is less elevated than the prior year, and so on and so forth. So you really needed those other cohorts to step in, and they have. Now that they have, the question is, can they be challenged? And I do think that between now and year end, a challenge is coming.
All right, challenge is coming in the gold space. We'll watch out for that one. You've been writing a lot about silver over the last little while, about the squeeze, about the unwind. What is going on right now with silver?
Yeah, I mean, the way we've been phrasing it to our clients is the silver squeeze you can buy into, right? That's been premised on this idea that the freely available stockpile of silver sitting in London vaults has been declining. It's been declining as a function of a structural deficit, but that's also been accelerated by the threat of tariffs, which incentivized traders to move metal from London into the US earlier this year. Now, over the course of this month, we've seen that climax. We've seen the structure of silver markets become so critically challenged that the price had to trade substantially higher in order to incentivize metal to come back into the system from unconventional sources. Now that that has occurred, we actually think that we're headed towards a silver flood. And what I'm referring to there is what will probably end up being the single largest wave of repletion of London silver inventories on record. Thus far, we think there's at least around 50 million ounces that has made its way back to London from the US, from China, and indeed from ETF liquidations. And that last bit is actually the most important because silver is typically seen as a giffen good, meaning people buy more of it as the price rises. The challenge now is that we've struggled to sustain a break above $50 an ounce, which is a psychological level. Because we've struggled to maintain a break above it, it might actually end up looking like a failed break, which is something that could change the psyche around silver as a giffen good. People might sell because it didn't manage to sustain that breakout. an ETF liquidation is equivalent to a direct addition to the free float as well. So that is, again, now becoming a self-reinforcing process to the downside until such a time that there are less available inventories in the US and there are less available inventories in China.
How much downside should investors be bracing themselves for? As you said, struggle to stay above 50. It's about 48.65 on my screen right now. If you get that flood of silver, how much pressure could we see to the downside?
Well, I want to balance that answer because on the one hand, it's very hard to see a scenario outside of a deep recession where silver can trade at $30, $35 an ounce again. On the other hand, most of the rally that we've seen in this last leg has been a function of a liquidity crisis, not of a demand surge, actually. By our accounts, the combined demand that pulled metal out of London was roughly the same size as it was in February 2024. And if you go back to your charts and look at how did silver prices look back then, you'd see that the price really didn't do all that much during that month. So this isn't a function of a huge wave of demand hitting silver markets and therefore the price is rising. It's a function of the fact that the market couldn't absorb what is a large but typical pace of demand over the course of the last month. That's now changing. So in our views, we don't need silver prices to be as high as they are today or to continue to rise in order to draw in metal from unconventional sources anymore, which means the path is to the downside.
Okay, so we covered off gold, we covered off silver. What's going on with copper?
Well, copper has a particularly virtuous cycle that is ongoing. Right? Firstly, from a supply-demand perspective, we've become accustomed to large-scale mining disruptions over the last year. But it's increasingly apparent that the world can no longer absorb these kinds of typical but large mining disruptions either. One large mine comes to mind recently that's had a very large disruption, and the market's assessment is that while we expect it to have a surplus next year, that surplus is gone. It's likely going to be a deficit year again. But even further than that, what I think the market is currently missing is this idea that because concentrate supply, what comes out of the mines, is becoming so challenged, this is actually the first year in several years where smelter output, the processing of it, which ends up delivering the units that are actually traded, the smelter capacity might actually decline as a function of the scarcity dissipate or emanating through the supply chain. That is a directly positive impact on copper prices. Separately, I'd say there's so much work that's been done on how much copper is going to be consumed by AI, and it is going to be significant. But another thing people are missing is how proximate this demand is. This isn't a 2030 story anymore. This is a 2026.
They want it now.
It's now, yeah, because data centers are being built as we speak. So 2026, 2027, even 2028, this is demand that is needed now. And further to that, we've not even really begun to consider how China will try to compete on data centers. Thus far, the US has really been leading the charge, but as you know, in the recent 5-year plan, AI has really been one of the focal points for Chinese policymakers. And so depending on how they choose to compete, this could potentially even double the copper demand emanating from AI and data centers.